What is happening with the dollar? What is happening with US bonds? What is happening with Trump? What is happening with the trade wars? What is happening? It is pure madness. And that is what we are going to talk about today. When we did last week's show, I thought this was going to be a pretty interesting week. And I think I said that I expected the markets to kind of open down early in the week, that we'd probably find a bottom and we'd start to bounce. And we'll talk about that a little bit more later in the show. But it was an even crazier week than I was expected for a number of reasons. And this week, there was something for everybody in this week. The people who think that Trump is an absolute idiot and would cave at the first sign of chaos, well, they got news that they're happy with. The people that thought that Trump would hold off before getting some concessions from others, well, they got something from their group. The people who were short had an opportunity to make money on the downside. The people who said everything was way oversold and it was time for a bounce, they had something. It's just a maddening week. But the big news of the week, the story, and especially for me, I mean, you can imagine, for those of you who have been following me, you can imagine how many emails and texts and DMs I got on Thursday and Friday, because the dollar had one of its worst weeks in forever. And it's not so much that the dollar had a bad week. That wasn't necessarily the news. The news was that the dollar had a bad week when rates were going higher. So we're going to talk about that as well. But long story short, the question that I'm getting now is the milkshake over? Is this it? Because when chaos hits the milkshake, that's when the milkshake is really supposed to work. That's when capital is supposed to flee to the United States, not leave the United States. So is it over? And the first thing I'll say is, well, especially for people who are maybe new and haven't heard this many, many times, the people who've heard it 100 times are just going to roll their eyes and say, oh my God, I don't want to hear this again. But for the people that are new, in order for me to answer all these questions, I do have to give a quick summary of what the milkshake is in the first place. And long story short, the milkshake is a framework I came up with to help me understand how markets would react in a sovereign debt crisis. A sovereign debt crisis happens when investors, institutions, financial intermediaries, however you want to describe people that operate in the financial markets, it's when they no longer want to buy the sovereign bonds issued by individual countries. And because of all the debt in the world, back in 2018, I was very concerned about all the debt in the world. And I wanted to understand what would happen if one of these crises were to take place. Because when I first started my career in 99, a year later, we had the dot-com crash, which was kind of a crisis within the equity market. And then 7 years later, in 2008, we had the global financial crisis, which was a crisis in the banking system and in the bond market. And in each of these crises, the Fed stepped in and, for lack of a better word, did a bailout. And it got kicked up to another higher level. But now we're sitting, then, after the global financial crisis, there was a crisis in Europe, the Euro crisis, the pigs, the Portugal, Italy, Spain, Greece. And it was somewhat of a sovereign crisis. And that's what made me start thinking about sovereign bonds of not just the pigs countries, but all countries. And that led me to finally come up with this milkshake theory. Because the debts were only getting bigger. They had been kicked because of the bailouts. They had been kicked up to the country balance sheets. In other words, the central bank balance sheets. The problems were no longer just sitting on corporate balance sheets or bank balance sheets. Now they were sitting on the central bank balance sheets. And I needed a framework to kind of understand what would happen there. And my thesis was that because of all the debt in the world, we would have a sovereign debt crisis. And when countries' bonds are rejected, interest rates would rise, because when bond prices fall, interest rates rise. So what I'm going to do is walk through quickly what the whole framework said and what's happened over the last 5 years. And then that's going to help us transition into what the hell is going on right now. So let me bring this up here. So let me, that's the wrong chart. God, we're not off to a good start here. Hold on. Well, first, let me show you this. So this is the dollar, and this is just over the last 12 days. The dollar is down 5%, and the last 2 days alone, it was down half of that, 3%. So 2 huge down days in the midst of what should, you would think, be a rally in the dollar. And everybody's like, well, why is the dollar falling? And I'll tell you why. First thing I'm going to say is, listen, I don't know for sure what's happening. Nobody knows for sure. All I can do is tell you what my 25 years of being in this business has taught me, and what my how many years have I been studying the currencies in the dollar? I don't know, 15 years focused on, or more, almost 20 years focused on, the currency markets and the debt markets and the monetary system itself, and what I think is going on. And then you guys can come to your own conclusion. I always tell you, I can tell you what I think, but at the end of the day, you have to decide for yourself. And so that's what we're going to be doing today. But there's no doubt it was a big down week for the dollar. And so this is what I call kind of the milkshake. And what I said back in 2018 was that in the years ahead, because of all the debt, there would be a sovereign debt crisis. And a sovereign debt crisis, including in the United States, not just the United States, not just the rest of the world, the whole world, if and when we had a sovereign debt crisis, I expected interest rates to rise. And as a result, I thought the dollar would go higher as well, because typically interest rates going higher in the US would pull capital into the dollar. As the dollar goes higher, because of the rest of the world has all of this US dollar debt, it would put pressure on the rest of the world. And as a result, I thought that would cause all kinds of problems, because there would be all kinds of problems in the world. I thought gold would rise. And I thought also if the governments of the world, not just the United States, but all the governments of the world, would respond to those crises with stimulus, QE, bailouts, printing of money, however you want to describe that, and that injection of liquidity was the milkshake. But I thought that the United States would capture much of that milkshake. And so I thought US equities would rise. So in that environment, the US dollar would rise, US equities would rise, gold would rise, interest rates would rise, and bonds would fall. So if we look and see what happened, that's pretty much so gold has done the best. Gold has gone up tremendously since I first mentioned this back in 2018. Purple is the S&P. It's gone up tremendously. Now, it's obviously had a huge drawdown. The other thing I said, by the way, over time, all of these things will go up together, but there will be terrifying drawdowns along the way. And that's exactly what we've seen. We're seeing another one right now. I also said I didn't know which order of the events this would happen. I said, I'm not smart enough to know that. I'm not going to get everything right. But if I get a little bit right, it's really going to help kind of understand the world. But so gold went up a lot. The US equities went up a lot. Interest rates, the blue and the white here, this is interest rates. They went up as expected. The dollar, it went up versus other currencies. And bond prices, that's this blue and orange, they went down. Now, initially, I was wrong about bonds. Initially, for the first couple years, interest rates went even lower. That's these right here. So in the first couple years, especially during COVID, interest rates went down. So in the early days, I was right about equities, I was right about the dollar, and I was right about gold, but I was wrong about bonds. But that changed with a vengeance coming out of COVID. And since then, interest rates have gone higher, bond prices have gone lower, and US equities and gold have gone higher. And the US has dramatically outperformed the rest of the world over that time period. Okay, so, and it was a result of capital coming into the United States. So a lot of times, and I said, ultimately, the US dollar would go back to its all-time high, gold would go to its all-time high, equities would go to their all, and we would have a crisis. Now, the reality is we haven't to the end game yet. So the framework has worked to explain what has happened, and the what I thought would happen has happened. But what has not happened is we never did have the global sovereign debt crisis, and we haven't reached the end of the line. And I think a lot of times when they hear me talk about the milkshake, they associate it with a one-time event, big blow up at the end. And they associate the end of the milkshake with the whole milkshake. But the milkshake is the process of this whole thing playing out. Now, what I think we'll do now is part of the reason that I thought that the US dollar would go higher is, in addition to all the demand for it and the euro dollar market that we've talked about many times, as interest rates go higher, typically the dollar goes higher with interest rates. And that's what we see. That's what this chart shows. The black line is the dollar index. The pink line is the 10-year yield. And so it's not always perfect. And of course, there's exceptions. But in general, you can see that that is what happens. And you can see, especially since 2020, as interest rates rose in the US, the DXY went higher with it. And you can see the correlation. Now, what has been different this last week is, again, we can see this correlation. It's a pretty tight correlation, but then we see this huge spike in yields and we see a huge sell-off in the dollar. That is pretty unusual. It's not that it never happens, and it happens occasionally, but it usually doesn't happen for very long. And like I said, it is rare. And so what we have seen since Donald Trump come in and his policies, capital is leaving the United States. And people said, well, Brent, isn't that the opposite of the milkshake? Yes. The short answer is yes, that's the opposite of the milkshake. For the last 5 years, capital has flowed into the United States. In general, has flown into the United States. Now, there are periods of time where it leaves. Back in 2022, when the markets were selling down, some of the capital would leave because it goes back to the countries who are selling U.S. assets because they need U.S. dollars in a downturn. Same thing happened in 2020, early part of 2020. And the same thing is happening again now. What's happening is the rest of the world owes not only, they owe in their own currencies, but they also owe in U.S. dollars. And when things start to turn down, they sell assets to pay off their debts. And when they're selling, right now, they're selling what they want to sell and they're doing what they want to do. It hasn't gotten to the point where the margin clerks are making the decisions yet. It's gotten pretty close, but it hasn't quite gotten there yet. So let's look at this. The reason I want to show this is February and March of 2020. The reason this is important is while we're not having a global pandemic now, we are having a global issue. The reason I like thinking about 2020, it was a global issue. It wasn't just pertinent to one country, it was pertinent to the whole world. And that is what we are seeing again this year with Donald Trump's enforcing these new trade policies. It affects the whole world. Now, if you remember this, so this is the DXY. In the early part of February, the dollar was going higher. And this is when the crisis was first breaking out. I remember I was on a plane right here at the end of January. My father died this week. And so I remember being on a plane. Well, first of all, I came home from Vancouver and I was on a plane and it was just breaking. And then right in here, my father died. And I remember I was on another plane. And so, and they were starting to talk about, you're going to have to wear a mask and they may have to shut down the planes and no longer flying, but it hadn't happened yet. But the risk is starting to percolate, right? And I remember, this is a little tidbit. I was on I was skiing for the weekend with some friends who work for very high level politicians in California. And I remember this weekend I asked them, I said, are you following this whole COVID thing? Are you worried about it? They didn't even know what I was talking about. That was on a Saturday. By Tuesday, they called me and they said, the only meetings we've had for the last 48 hours are all COVID related. But essentially, this is when things really broke out, the last week of February or the last 10 days of February. And what happened over that time period? the dollar fell. You want to guess how much it fell over a 12-day period? Now, we just had the dollar fall 5% over 12 days. You want to guess what happened over these 12 days? 5% over 12 days. The exact same thing has happened over the last 12 days in this current global event as happened during that 12 days in that global event. But when things got bad enough and when people were no longer making the decisions for themselves and the margin clerks stepped in, what happened? In 10 days, the dollar went up 9%. The point is when people are making their own decisions and things haven't gotten systemic and it's just unsettling and concerning, one decision is made. But when things get systemic and they get to real crisis level, that's when the dollar behaves differently. And I think that's what's happening again now. So let's talk about a little bit about what is happening now. First thing, I'm going to take a step back. Part of the reason that I have said that the dollar will ultimately go a lot higher is because of the design of the monetary system. All money is loaned into existence. So there is all this debt in the world. And until you pay off the debt, you have a demand for the currency. And the reason that the dollar is so important and will last longer than everyone else is because the US has an incredible amount of demand for the dollar outside the United States. That's the euro dollar market. But inside individual countries, they all have the same design as the dollar. They just don't have the euro dollar market for their own currencies outside their domestic borders. But they all have debts that have to be repaid. And when things start to get crazy and start to sell off, they have to meet those obligations. They have to be careful. They have to liquidate certain things. They have to put some money in reserve. They have to pay off their local debts because those local debts are often more short-term and more critical short-term than their longer-term US dollar debts. So if we look here, if we go back to in 2020, people around the world were selling their US assets and they were taking those dollars that they received, exchanging them for their home currency. So it was pushing the dollar down, pushing their local currency up, and repatriating them back to their own countries to deal with their local currency debts. And that is why the dollar fell 12% or 5% in 12 days. Let's look and see what's happening right now. Now, this is a chart of global stock markets, just risk assets. This is the number of stock markets. It's a number of commodities, just a number of different ways to look at risk assets around the world. And I did this. This is starting in March, so about 5 or 6 weeks ago. Now, the reason I used March, I can do it year to date as well, but well, let's just do it. Okay, hold on. Let me do this year to date. So year to date, if we look around the world, what is happening is stock markets are kind of flat to down. So, look here. So the Dow is down 6% for the year. The NASDAQ's down 12%. The DAX is actually flat for the year. The Nikkei is down 15%. Copper is up 12% for the year. Oil is down 15% for the year. So et cetera, et cetera, et cetera, right? The Hang Seng is up 4% for the year. The Shanghai is down 4% for the year. But now let's just go over the last 5 weeks. Because that's kind of when things started to turn south. Because for the first month of Trump's presidency, everything was fine. He started to make some noise in February, but things really kind of started to go sideways I did the wrong. That's March 2024. Hold on. Sorry. March is when things kind of started to turn down. And so since then, the NASDAQ is down 9. The Dow's down 7. The DAX is now down 12. The Nikkei is down 12. Copper is now down 2%. The Bloomberg Commodities Index is down 2%. The Helsinki is down 13%. The Hang Seng, which is Hong Kong, is down 9%. So you can see things have started to sell off here. But the point is things haven't just sold off in the United States. A lot of people are focusing on the United States because they say Trump is shooting himself in the foot. Look what the markets are doing. How can he be so stupid? But he's not just shooting the United States. He's shooting the United States. I'm not denying that. But he's not just hurting the United States. This is a global thing, and it's a relative game. So now that's since March. Now let's just look since April 2nd, since the day of the tariffs, right? So let's change this to 040, Liberation Day. We're going to take a look at Liberation Day here. Okay, so since Liberation Day, it's so funny that people call this Liberation. I feel like Liberation Day is going to be around forever. It's just going to be one of those words that we use that's, just ridiculous and hilarious at the same time. Okay, so since Liberation Day, the Dow's down 5, another 5. The DAX is down 10. The Nikkei's down 6. Let's see. Europe's down 10. Hong Kong's down 10, and Shanghai's down 4. So the point is the U.S. is down 4 or 5 to 10%, depending on which market you're looking at, but so is the rest of the world. And as the rest of the world is dealing with these tariffs, they're not sure what Trump is going to do next. There's a lot of uncertainty. What are they doing? They're selling their assets and they're taking them back home to deal with their local debts and their local needs first while they wait and figure out what is going on and what they're going to do next. And as a result, the dollar is falling. Now, that's 2020. As the result, the dollar is falling. And so why are yields going so high? So I think that is why dollars are falling, because the world is selling U.S. Treasury bonds, they're selling U.S. stocks, and they're trying to get clarity on what comes next. Right now, there's great uncertainty, and in great uncertainty, you just get to the sideline. Okay? But so why are they selling bonds? Well, part of the reason they sell bonds is because they own a lot of them. And that's a source of dollars. And that's a source of funding. And again, they don't know. Is Trump going to take their treasury bonds? Is he going to take their foreign reserves? Is he going to put a tax on capital in the United States? There's a lot of uncertainty. And so capital is leaving the United States right now. So that is part of the reason. I don't think China is selling treasury bonds, by the way. I actually don't think that is correct. And I'll tell you why I don't think they are. But I think Japan probably is. Europe probably is. Just whoever needs treasury bonds or dollar liquidity is probably selling them. And the other thing, so this is a huge move up in yields. So why are yields moving up so much? The reason yields are moving up so much is I think foreigners are selling treasury bonds to a certain extent, but I don't think that's the big one. I think the big one is there's two different leveraged trades that have been going on. And those two leveraged trades involve buying an enormous amount of treasury bonds on leverage. And I'm not going to go into details of it because it gets too long. You should definitely go out and check out. I'll put the link of it in the description in the show description here. Go check out Jeff Snyder's Eurodollar University. He's talked about this a couple times this week. He does a better job of explaining it than I can. But there's two different trades that are going on. One of them is called the Treasury. It's a basis trade, and the other one is an SLR trade. The SLR trade has to do with a regulatory change that's coming up, and as a result of this regulatory change that's coming up, the belief was that the spread, there's a swap spread trade based on the supplemental leverage ratio, that they would expect that swap spread to tighten. And so a lot of banks, hedge funds, maybe insurance companies, they piled into this SLR spread trade with leverage. And it's typically fine because typically treasuries aren't that volatile. But then Trump comes in with his tariff policy, and that spread, rather than tighten the way many expected, smartest people in the room got it wrong again, it widened. And as it widens, they have to unwind that trade. And as part of unwinding that trade, they have to sell a bunch of treasuries. So I think that's what was going on here. At the same time that foreigners are looking to the U.S. for liquidity because so much capital has flowed into the United States over the last several years and pushed our markets to new highs. That's where a lot of liquidity around the world has gone. But now they need that liquidity back at home. They're tapping those funds as a source of funds. And as a result, that's why the dollar's going down. And then that combined with the basis trade and the SLR trade unwinding, you see yields jumping. Now, I will tell you, I think that this is way overdone on the dollar side. Now, to be clear, I am not a treasury bull. We, in fact, were expecting bonds to go lower. We had puts on TLT. I think I mentioned that last week. We sold most of them this week. We still have a few, but not as many. But as the treasury bonds took a hit this week, we sold most of those. So I'm not necessarily expecting yields to fall. It won't surprise me if they do. I don't have a real strong opinion on this, but I do think still that we're going to have this sovereign debt crisis, and in a sovereign debt crisis, yields rise. And so I'm not necessarily expecting this pink line to come crashing down, the yield to come down, but I would be surprised if we continue for a long time to see yields in the U.S. go higher and the dollar continue to go higher. I'm not going to sit here and say it can't happen. Anything can happen. But I would be surprised if that happens. I think things have gotten too far overdone. And remember, as the dollar goes down, that means another currency is going higher. Let's look at, let me just real quick, I have this up here somewhere. Let me see if I can find it. Oh, here it is. So this is the euro. This is a chart of the euro. This goes back about 5 years. Now, this has been a huge, as the dollar has come down, the euro has spiked higher. Now, think about this. In Europe, financial conditions are tightening because this is risk off for the whole world. In Japan, financial conditions are tightening. Japan and Europe, those are export economies. Now, in those export economies, you typically don't want a super strong currency because it makes your goods more expensive. So if those countries are already experiencing very low growth, and now you have financial conditions tightening, and their currency is now strengthening, that is going to put incredible amount of deflationary pressure on their economies. And they are going to end up going to be needing to cut rates. So my point is I don't expect this to continue up like that. Now, can it? Of course it can happen. But that is not my expectation. The other thing is if you look at the RSI is starting to get pretty high on the euro. You look back every other time it's gotten this high, it has rolled over. If we were to do this same, if I change this to the dollar, just look at the dollar here. The exact opposite on the dollar, right? It's down. It's way down here. And so, this is typically where you would want to sell the euro and buy the dollar. So can the dollar go a little bit lower in the short term? Sure, it can. My expectation is for a bounce. If the Fed were to come out and do QE, then, maybe the dollar goes lower and maybe we have a repeat of, 2020 and 2021. But remember, if that happens, all that does is kick the can down the road. Why? Because the way that you increase dollar liquidity, which would cause the dollar to go lower, is by increasing the amount of US dollar debt in the world. And so while it increases liquidity short term and causes the dollar to fall, it also increases demand long term, and we end up right back where we are. That's why despite everything that happened in 2020 with QE and the bailouts, and the dollar, remember when we saw that, the dollar came all the way down here. It wasn't very long, and then it went to a 30-year high. So could we have a repeat of this where the dollar goes from 100 down to 90 and then back to 120? Sure, we could. But that just delays the game. It just makes all the problems bigger. So long story short, what I think is happening is the rest of the world is dealing with their short-term carry trades at home. They're paying off their local leverage with the liquidity that they're getting right now in the short term. But if things continue to go down, then we're going to get the carry trade unwind on a global basis. And the global carry trade on a global basis is done in yen and dollars. And that is exactly what happened back here in 2020 when things Sorry, where's this chart at? Oh yeah, this is when local carry trades were getting paid off, the dollar fell, and then as soon as the global carry trade started to get unwound, it went the other way very quickly. So that's what I think is going on with the dollar and rates right now. We're going to have to wait and see how this week's goes. I expect it to be another crazy week. But in general, I think we probably found a short-term bottom last week. I think I think there'll be volatility this week. I think by Friday, markets will probably be at the same level and probably higher. But I do not think that we are out of the woods yet. I think we will probably, go lower into the summer, but there was going to be these massive rallies along the way. Remember, we had a 10% rally on Wednesday alone just because of something Trump said. So I expect there to be great volatility in both directions, but I don't think that we are out of the woods completely yet. I told you I thought that we would maybe buy this week. We did for some clients that were a little under allocated equities. We did start buying a little bit in equities. So things were very, very oversold short term. But I think what I would talk about now is I sent out a tweet this week where I said the four things, I called it the four most important charts in global markets. And I thought I'd just give you a little explanation for those. And the charts were the 10-year, the US 10-year yield, the yuan cross rate with the dollar, the price of gold, and the SOFR rate. The SOFR rate is the secured overnight funding rate. And so I'm going to talk a little bit about each of these markets. So the reason I think these are the most important, and somebody said, well, why isn't the dollar the most important chart? The reason is because the dollar is reflective of everything else, right? The dollar is just a cross rate with every other currency in the world. And while the dollar going higher is certainly important, and it's one of the things I look at all the time, the level of the dollar is really just reflective of things that are going on in the rest of the markets. It does impact all the other markets, but the DXY index is really focused on the euro. I suppose I could have put on here like the broad dollar index, but then I would have also had to include like the Asian dollar index. But the bottom line is, the 10 years in many ways related to the dollar index. They often trade opposite. They don't always trade opposite. But the point is the reason this is important is because the whole world owes US dollar debt. The rate at which the US has to borrow affects the whole world. When rates go up in the United States, this affects two things. It affects variable rates all over the world that are priced off of the US 10-year. So as the interest rates go higher, is it bad for the US? Yes, it's bad for the US. But it's even worse for the rest of the world because they typically pay a premium to this. And a lot of corporate loans and securitized loans, and it is all priced off of the US 10-year Treasury. And if you can get 5% for sitting in a treasury, which you pretty much have to operate on the global stage or to pledge for collateral, or to meet certain regulatory requirements. If you can get 5% for holding a treasury that you'll never get fired for, why would you hold an Egyptian bond that pays 6%? You wouldn't. But the point is the higher U.S. rates go, the higher rates around the world have to go to compete with it. So that's part of why it's so important. The other reason is as rates go higher, bond prices fall. And what is the primary asset held around the world, both on corporate balance sheets and central bank balance sheets as reserves? U.S. Treasury bonds. So as the interest rates go higher, those bond prices fall. And even though they're not typically marked to market and they're marked to maturity, it is still puts pressure on their balance sheets, and to where if those companies or if those corporations start seeing outflows and they have to start liquidating treasury bonds, they quickly get upside down. So that's why this is an incredibly important chart. And it's why I say if interest rates go higher, it puts pressure. U.S. interest rates go higher. It's not just a crisis for the United States. It's a crisis for the whole world. Now, related to this is the yuan. So this goes all the way back to 1990s. You can see here the yuan rate was 5.5, and they did a devaluation of like almost 100% up to about 40, all the way up to 8.5. And so then it was there and it was pegged for a number of years, and then it strengthened, and then it strengthened over a period of about 10 years from 2005 to 2014. And since then, it's been kind of going the other way. If people remember, in 2015, right here, it wasn't very big, but there was a small mini deval. So as this chart goes higher, that's the yuan losing value. In August of 2015, there was a 2 or 3% deval, mini deval of the yuan that kind of came out of nowhere, and that caused havoc across global markets. Just a little 2 or 3% unexpected deval. So the reason this is the most important chart is because this is a pegged currency. This means that China's currency is not set by the market. It's set by a board of governors in China that pegs the currency. Now, how do they peg this currency? As dollars flow into the United States, the central bank takes the dollars, it gives whoever sent them yuan. That yuan goes and gets spent. That yuan is printed out of thin air and gets spent into the Chinese economy. And then the Chinese central bank, PBOC, takes those dollars and they buy yuan on the open market to peg the currency at a certain level. And as long as dollars were flowing into China, that worked great. But dollars are no longer flowing into China at the rate they once were. And in fact, a lot of dollars are now trying to get out of China. Money's trying to leave China because of all the problems that they have. And so they then have to spend the reserves that they have. Now, if and when they ever run out of reserves or no longer want to use those reserves to peg this currency is going to spike higher. That is a deval. And as they deval, the reason they would do that is they have incredible deflationary pressure inside China. They would devalue their currency in order to counteract those deflationary forces. But if they do that, that means they're importing inflation into China to counteract their deflationary forces, and they're exporting or sending out the deflation to the rest of the world. So if China devalues, two things happen. Their currency becomes worth much less, and the US dollar compared to the yuan spikes. And when the US dollar spikes, we already know that puts incredible pressure on the whole world. That is an incredibly globally deflationary event. That happens, it's chaos. Remember when I said here just a 3% mini deval caused chaos in the markets for a couple of weeks? If this peg breaks and it goes from 7.5 to 9 or 10 or whatever it is, it will be chaos. You'll have instant QE, bailouts, all over the world. And so, but China does not want to deval. And China devaluing would not hurt the United States. China devaluing, listen, it would hurt the whole world. I shouldn't say it wouldn't hurt the United States. It would hurt the United States because it would be a deflationary wave that the Fed and every other central bank around the world would have to deal with. But it would be a global event. But it would really put pressure on China because now they would have a currency that was worth even less. And you got to remember, they need dollars to buy oil and commodities and And I know there's people out there that will tell you that they can buy oil in yuan. Sure, they can buy oil in yuan, but it's priced in dollars. And so it's going to take a lot more yuan to buy the dollars to then buy to buy the oil. And even if they can buy with yuan directly, it's going to take a lot more yuan that they're going to be printing out of thin air to buy needed imports. And that's going to put incredible inflationary pressure on their economy. And it would be China does not want that to happen. China does not want to devalue their currency. They may have to do it as a last-ditch effort, but they don't want to do it. But it would be a globally systemic event, and that's why it's one of the four horsemen. Gold is obviously on here. I mean, to me, the first thing, for as long as I can remember, the first thing I look at in the morning when I wake up on my phone is the gold price of gold. And the reason to me is the gold is the original VIX. I mean, that is the true barometer of what's going on in the world. If I wake up and gold has not moved more than 10 or 15 bucks, I don't even think about it. But if it's moved 20, 30, 40, $100, which we have been seeing lately, that's showing there's something going on in the world. So if I wake up and I see that gold price is either up 20 bucks or down 20 bucks, I know something is going on that warrants further investigation to see what it's about. And I've always believed that gold is kind of the cornerstone of most portfolios. It's why I've said forever that everybody should own it. It's why I said as the global sovereign debt crisis would kick off, I thought that would be good for the price of gold, and it's why I've said forever that gold would go to $5,000, and we're at 3 now, and when we get to 5, I don't know, but I'm not surprised at all that gold's at $3,000. Now, this is the SOFR rate. Now, the SOFR rate, some people ask me, how come I didn't say the federal funds rate? The SOFR rate is what does it stand for? Standard overnight. God, I can't remember what the exact terminology is, but it's basically a market-based rate between banks and financial institutions. It's basically that is set by the market in the repo market. And so it's the cost of funding between banks overnight. So the federal funds rate, that's just a target that is set by the Fed. But this is an actual market-based rate. And so when you see craziness in this, if you were to wake up tomorrow morning and you were to see the SOFR rate at 6%, holy cow, something's really going on. If you wake up tomorrow morning and the SOFR rate's at 375, holy cow, something's going on. Why is it moving so much? What's going on? This is the sign of if there's funding liquidity or funding pressure in the overnight markets in the banking system. So to me, this is one of the most important charts to look at. So those are kind of the 4 horsemen. One thing I'll do before we wrap up for the week here is just take a quick look at markets for you. Again, when we came in last week, we had already had some big downside. We said we might see a little bit more. We did. We saw it on Monday. You can look here. This, I've said many times, back in when was it, last July, when we were at this peak, and we showed on the RSI how overbought it was and how high the stochastics were, and that was an indicator for us that the top was probably in, and it was probably time to buy some hedges. And then sure enough, we saw this huge downturn. Well, now we saw the exact opposite. Okay, now we saw, this is let's just go back 5 years, probably as low as we've seen. And let's go back all the way back to COVID. The last time we saw markets this oversold was COVID. Okay. But that's how oversold markets got. All the way down here at 20, the stochastics got all the way down to 10. So, or that was a little bit ago. I guess I'm a little bit, that was about a month ago. But the point is they're extremely oversold, and markets do not move in straight lines. Even though I've always said the dollar is going to go back to its all-time high, gold's going to go to $5,000. It's not going to happen overnight. It's not going to go in a straight line. You're going to have, starts and stops, and you're going to have pullbacks along the way. And even though I think we probably go lower on equities into the summer, I don't know. Maybe we won't. This is a pretty big sell-off, and it's everything's very oversold. And at a minimum, I think we're due for a bounce. But these are some of the signals that we've gone over before that kind of helped me make that decision. Here, if we look at TLT, this is the bonds. They're oversold, but not dramatically. The RSI is kind of still in the 30s. The stochastics have turned down, but they haven't absolutely collapsed. But it's been a big move. It's been a big move lower. And, again, perhaps we see a little bit lower. My guess is that we'll see a little bit lower in bonds, and then we'll see a bounce for a week or two. And then those will go lower into the summer as well, unless we get some kind of a crazy systemic event where just liquidity just dries up everywhere and bond rallies. This is the dollar again. Again, we see how oversold it is. The stochastics came all the way down here. Relative strength is low. And the euro is the exact opposite, and many of the other currencies are the exact opposite. So expecting a bounce there as well. You guys like it? I get a lot of comments when I show this to the COT report on gold and silver. So this is a really interesting chart. You guys have seen me show you this before, but what's really interesting this time is you can see over the last couple of weeks, especially this last week, the commercial shorts were covering. The annoying thing, the annoying thing about this is, so on Monday and Tuesday, gold went down a lot. I think on Monday, was it Sunday night and Monday? I think gold fell $100 overnight and then bounced. And so let me just, so I would get, and these are delayed. The pink line, the black line is real time. The pink line is delayed. So this pink line is as of Tuesday. It's not as of Friday. But what happened on Monday and Tuesday was that the gold price, you can see the price came down. And intraday, I think it went from like 390, no, 3190 to like 3090, in a day. And then it just rocketed back higher, and now it closed it. So, but the point is I think a lot of this covering took place when the gold price was coming down. My guess is that as gold spiked back higher over the last 3 days, my guess is when we look at this next week, this will now have come back down. But if not, if this is higher, I mean, that explains why gold is rallying so much, because what you're seeing is a commercial short squeeze. So it'll be really interesting to see this next week. Now, if we look at silver, kind of the same dynamic, not as dramatic, but kind of the same dynamic here. As the price went higher, you saw, again, this is delayed. This is, I think they were probably covering as the price of silver came down. My guess is as this went higher into the week, then this will have come back down. But it would be nice if these two, if there wasn't a time delay, but they are. In any case, this went on a little bit longer than I expected it to. I hope that makes sense. I hope it provides some clarity. I, for one, don't think the milkshake is over. I think this is a temporary thing. This is what, I need to say this as we wrap up. So everything you're seeing now is kind of a mini version of why eventually I think the milkshake will end, and why I think eventually capital will leave the US, and why eventually capital will no longer come back. Now, I don't think we're there yet. I think we're in a drawdown. I think when the dust settles and when things get a little bit more clear, or when things get even more crazy than they are now, I think capital will still favor the United States over everywhere else. Now, if I am wrong, then the milkshake's over, and that's it. I'm happy. If and when that happens, I will happily admit that. You have to remember, the whole point of this is not to be right. The whole point of this, from my perspective, is to make money. This framework has helped me make money over the last 5 years and sleep at night while doing it, and not have to worry about the huge drawdowns and the existential, angst of what's going on in the world. It's provided me a lot of clarity. It's provided my clients a lot of peace and understanding. And if I end up being wrong going forward, then so be it. I would rather make money than be right. So far, we've had the luxury of doing both. But if and when the world changes and this framework no longer works, then we'll have to pivot. But as of right now, I've seen this story before. I saw it in 2021. I saw it in 2023, and every time it is rebounded back the other way. So we'll have to wait and see where it goes from there. But I'll be back again next week and give another update. And in the meantime, hope you and your portfolios stay safe. All right, have a good one. Bye.